Welcome to the Everyday Investor. Investing's never about just the tools, it's about what you're trying to build and why you're trying to build it. The right set of skills can earn you a great income. If you want to get good at getting that income working for you, you might need to learn some new skills. That's why we do this podcast. We're trying to learn together to get better at getting our dollars to work for us. So we start by being curious. We listen to a few opinions from others smarter than us, and ideally, we listen to those that are still learning as well. And if we do all this, we should get the skills, and we should get better at doing the job. So today, I'm talking with a smart person sharing his opinions about the Central Bank of New Zealand, known as the Reserve Bank of New Zealand. And I think this type of conversation will help us develop some of the skills that we might need in the future. Now, the Reserve Bank of New Zealand, much like any central bank, holds a phenomenal amount of power. It's been said many times and in different ways by a lot of different people, but he who controls the gold controls the world. If the behavior or tactics from these banks appears to be having a negative impact in some way in our life, it's a good excuse, I think, to learn a little bit more about how things work and why. Especially in the context of war, we're going through another evolution, it seems, in so many ways. And so it's okay to wonder how these changes out there affect the investments in here, what you hold. This could be an incredibly amazing time from a nominal rate of return point of view, just because of some of the things that might have to happen involving central banks. Or things could actually go horribly wrong if they make a policy error or they fail to achieve what they're trying to achieve. Of course, things could actually remain exactly as they are, and we need not worry about such matters. But you're not a conspiracy theorist to look up and down, and especially when everyone else appears stuck on the left or right, that could be an advantage to you. You might be able to see some risk that other people might be ignoring. I think everyday investors should be more macro aware, and I didn't always believe that. This has been just in the last few years. After each market cycle, chances are you don't need to worry about this sort of stuff because it's just another cycle. It always feels different this time around, but it never is. Every now and then, though, there can be this thing known as a secular shift, and it could change the rules of the game. Different interventions by central banks might work in different ways. Even if it's unlikely, the return that we get going forward has to be higher now to accommodate for a higher risk of uncertainty around all this. And I'm not saying that it's different this time around, but I am saying that after we invest according to everything best practice, we should still zoom out. Apply a light geopolitical, technological, sociological, historical, or even spiritual lens over what you're seeing. You're not looking for something that's not there. You're just creating a process to flush out the risk. There's always noise, but how big do the warning signs have to be before it gets your attention? That should be defined. Now, you don't have to have an interest in central banking to be a good investor. I just got to put it out there. But if you want to be an informed citizen, though, try to understand how arguably the most influential institution in our country has almost no accountability to taxpayers. What am I driving at? In March 2020, the Reserve Bank of New Zealand gave money to the government who spent it as poorly as they could, it seemed. And then they lowered interest rates to record lows and kept them there for far too long in an attempt to stave off deflation and recession while coping with the pandemic during the early stages. They wanted to create inflation because that's the best defense from deflation. The strategy didn't work too well, or it worked far too well. But now there's a little problem of a mistake that's been made and no one's really fessing up to it. Between the central bank and the government, they've cost us over $12 billion from a bad bet, which they haven't even acknowledged. Michael Reddell is a former economist at the Reserve Bank of New Zealand and a current economic and geopolitical commentator. This is a great conversation, and anyone still learning will probably love this. We have a couple of really good Chasing the Joneses episodes coming up too. If you're down with more of a personal finance tilt, keep an eye out for these occasionally on a Friday. Well-known influencer Simone Anderson joins us in one. I break down the past, present, and future of money on another. And in another one, we'll go over some of the results of the survey that you can still complete now if you like. It's entitled, How Are You Doing? I just want to know how you are all coping with higher inflation and higher mortgage payments. So if you have exactly 2 minutes, please jump in there now and take that anonymous survey. It's just a few questions. All right. Long enough intro? I think so. Let's start.
You're listening into the Everyday Investor Podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor Podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial Advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. Maybe if you could just talk to me a little bit about what you fill your days with at the moment. I know you from Croaking Cassandra. That's your blog. Do you want to just tell us a little bit about what Croaking Cassandra is?
Yeah, so Croaking Cassandra was a blog I set up when I left the Reserve Bank back in 2015. And, back 15 years ago, around the time of the global financial crisis, was the great age of economic blogging. And I used to read a lot of good blogs, often by academics, sometimes former government officials like me. And you'd learn a lot. It would stimulate your thinking. And I was aware of how little serious economic commentary there was in New Zealand. And so when I was facing up to leaving the bank, I thought, this would be something that would be good for keeping my brain ticking over and might enable me to make some contribution, not just to advancing ideas that had been important to me when I was a public servant, but also just lifting the quality of New Zealand economic analysis and debate.
And I think that's really important, especially at the moment, right? Like I think to a certain extent, maybe in the past, especially, you could probably ignore all those macro factors. And I guess the Reserve Bank of New Zealand, or central banks in particular, is a great little on-ramp to get into understanding a bit more about how the macro economy works, which I think increasingly will become important. So we'll get into that as we go in to our discussion today. But it's been 8 years since you've been out of the Reserve Bank as the economist with the Reserve Bank. Can you just tell me, and I want to start really, really gently here so that everybody can learn a little bit, hopefully, with this episode. Can you just tell me, what is the Reserve Bank of New Zealand, or what is a central bank to start with?
Okay, so at its most basic, what a central bank's doing is issuing our banknotes and our coins. Prior to the mid-1930s, banks here issued banknotes, and we used foreign coinage, introducing our own money, not just the physical currency, but banks who bank with the Reserve Bank as well, drawing on that base, enabled us to influence economic conditions in New Zealand. So the experience in the 1930s had been that we were caught up in what was happening in the wider world and didn't have any policy capacity to do anything about it ourselves. So what the Reserve Bank does these days, notes and coins are still an important part of the basic underpinning of having your own central bank. But, as you know, most people don't use much physical currency these days. The much more important role that they play is banker to the banks themselves. And the interest rate that the Reserve Bank sets on the deposits banks have with the Reserve Bank, or the interest rate the Reserve Bank charges when it lends to the banks, is the way in which it influences economic conditions. Now, Parliament set out that the goal of the Reserve Bank primarily is to keep inflation low and stable. And what the Reserve Bank is doing is trying to look at economic forecasts, get a sense of where the inflation outlook is going, and then adjusting, if you like, the price of money, the interest rate, to influence spending patterns in New Zealand to try and keep inflation in that target range that the government has set for them.
So in a sense, it's kind of like, if we bring this to a household context, it's like changing things within your household or influencing things within your household so that you can be better equipped to handle kind of like the environment and the international scene as well, right? Like what you're saying before is that coming out of the 30s, we had little influence over how New Zealand was performing relative to the rest of the world, but the inception of the Reserve Bank and the issuance of our own currency allowed us to exercise some influence over things which we weren't able to do before. Is that right?
Yeah, that's pretty much right. And it's doing so indirectly. So the Reserve Bank is adjusting its main instrument as an overnight interest rate. It's not an interest rate that you or I pay. It influences a small number of transactions between the Reserve Bank and the banks, and yet it has a pervasive influence right across the economy. It affects borrowing conditions, spending conditions, the exchange rate, for example. And we all, as individual householders and firms, respond to those pressures that we see in the borrowing and lending rates or the exchange rate and adjust our behaviour.
And so when we think about the Reserve Bank of New Zealand, because it has the word bank in it, I guess the tendency would be just to conflate it with ASB or Westpac or ANZ, these retail banks that we deal with. How can we kind of just separate the two groups or visualize where the Reserve Bank of New Zealand sits relative to these other banks?
Well, the key way to think of it is probably that the Reserve Bank is the banker to those banks. So the Reserve Bank doesn't lend to you and me, doesn't offer accounts or facilities other than banknotes, but it does bank a range of institutions, almost all banks, who hold deposit accounts with the Reserve Bank. They used to operate on very small balances. These days, there's about 60 billion of deposits held with the Reserve Bank as a result of the asset purchase program that was done through COVID. And the OCR is just the interest rate that the Reserve Bank pays on those deposits with the Reserve Bank. If you change that interest rate, you'll change bank behaviour, you'll change financial prices and conditions right across the economy. So the Reserve Bank, if you like, is the apex of the system.
So starting from maybe the pandemic to today, with respect to the Reserve Bank's activities with buying assets, could you just like define, well, what are those assets and what was that designed to do during that period of time?
Yeah, so if we go back 3 or 4 years just prior to the pandemic, the system used to operate with balances of about $7 or $8 billion at the Reserve Bank. And that was just enough to cope with the interbank payments that were taking place between banks on behalf of their customers each day. Then when pandemic got going, first the Reserve Bank cut the OCR 2.25%. And then they said to themselves, well, we don't think this is enough. We think we need more stimulus. They didn't think at the time that they could take the OCR negative for various operational reasons that we could come back to if you want. But they said the best way we think we can add additional stimulus is by going into the market and buying government bonds from private sector holders who own them. If we buy those bonds, we'll drive up the price and lower the interest rate on the bond. And their argument was that if they'd lowered those long-term interest rates, that would stimulate demand in the rest of the economy. It would help weaken the exchange rate, and it would help to lean against what we all thought was going to happen in 2020, which was with the pandemic, people would retreat into their shells, they wouldn't spend, investment projects would be put on hold, and if anything, there would be a risk of deflation. Now, the Reserve Bank and most economists, and I include myself in that category, got that wrong. But that was the mechanism that was behind their thinking.
Yeah. Okay. So when you say that they went into the market to buy government bonds, that I'm just thinking supply and demand. So that increases the demand for something, but with bonds, that actually decreases the interest rate, right? And so
increases the price and lowers the interest rate.
Yep. Increases the price. And so that was like, that's how, and this isn't just unique to New Zealand, right? So can you just explain to us how central banks, what that's called overseas when central banks go out in the market and do exactly just that?
Yeah, so quantitative easing was the label that became attached to these operations, which a bunch of other central banks have been doing. The Bank of Japan first started about 20 years ago when their policy rate got to zero and they were still struggling with deflation. But it became much more prominent at the time of the crisis in 08-09. And you saw the Bank of England and the Fed intervening to buy bonds, both government bonds and private sector bonds. And then the ECB came in behind and have been large buyers at times since. Different central banks have had different emphases on how they think this mechanism works. So the Japanese argued that if they simply put more money in banks' accounts, the banks would want to lend. And so they emphasized the term quantitative easing. Most other central banks, including the Reserve Bank here, didn't emphasize that channel. They emphasized the idea that we can influence interest rates. And so they've tended to use that label, LSAP, or Large Scale Asset Purchase Program. The Reserve Bank, rightly in my view, doesn't believe that simply putting money into accounts of banks and then paying interest on it makes any difference whatsoever. They argued that what they were successfully doing was lowering those long-term interest rates, and that would affect demand and willingness to spend here in New Zealand, as they argued it had done abroad. Now, in the international literature, there's quite a lot of debate about just how effective those programs have been over the years. I think there's little doubt that in the middle of the 08-09 crisis in the US and the UK, there was some beneficial impact in stabilising markets. It's much more contentious whether those sorts of interventions have made any useful difference to the interest rates that you or I or firms face. And that was particularly so in New Zealand because the Reserve Bank was disproportionately buying bonds with a 5 to 10 year maturity. And as you and your listeners will know, most people in New Zealand, and particularly most mortgage borrowers, aren't borrowing at a 5 or 10 year fixed rate. They're borrowing at either floating or maybe 6 months, 1 year, 2 year fixed. And the 6 month, 1 year, 2 year rates were already being anchored by the OCR itself. And so I've argued pretty strongly that probably this huge intervention, buying 55 to 60 billion of bonds, didn't actually have much useful impact at all.
In light of the fact that there was hardly any useful impact because they were influencing rates on the longer end of the spectrum, which most New Zealanders don't interact with, it's kind of like a redundant exercise. But what about the side effects then? So can you talk to me about what the harm was potentially done or what we now have as a result of that $55 to $60 billion buying?
Yeah, I mean, some people will argue that those purchases contributed heavily to the inflation that we've seen in the last 2 or 3 years. I'll come back to that in a minute. I don't think that's the case. I think the most evident consequence and cost has been the massive losses that the Reserve Bank has run up on those bonds. So what happens? They bought bonds almost at the peak of the market. They were borrowing at a time when long-term rates were 1% or less. They're now in the process of selling those bonds back to the market via the Treasury. And the total losses estimated on this program now are around $12 billion. These are absolutely staggering numbers. People worry about, 55 million being spent on scoping studies on the cycling bridge over the Auckland Harbour, or this or that or the other thing. Hardly anything in this country has cost us $12 billion, and it's just gone. It's money that we didn't need to lose, and those costs are still mounting each month as bond yields continue to rise.
When they went out to the market initially, they were trying to influence interest rates downwards on the long end, and so that was done by driving up the price of bonds by going to the market and gobbling them all up. So now they bought at the peak. What do you mean by that peak? Like they bought it because they were trying to force it down?
The biggest thing that was going on in 2020 wasn't so much the Reserve Bank influencing rates. It was the wider market believing that, if anything, the risks at the time were of deflation. So if you look at market forecasts and Reserve Bank forecasts for that matter, in the middle to second half of 2020, there was a real concern that we were going to see inflation approaching zero and staying there. The Reserve Bank at the end of 2020 thought that it would take 3 or 4 years for inflation even to get back close to 2% from the bottom side. So their activities probably pushed down interest rates a little, pushed up the price a little. But the much bigger influence was that misjudgment by them and by the market as to what the economic outlook was going to hold. So hardly anybody in 2020 envisaged that a couple of years later we would have 5, 6, 7% inflation and would need policy interest rates to be 5 or 6%. Again, you can look at either market prices or Reserve Bank forecasts or market commentators' forecasts, and almost every single one of them envisaged that it would take perhaps 2 or 3 years before the OCR was raised at all, and when it was raised, maybe it would struggle to get back to 2% or something of the sort like that. Right. So when the market and the bank proved to be wrong, what happened was a massive change of view that's still going on, and bond prices fell very sharply. Bond yields rose. If you're the Reserve Bank sitting on a very big stock of bonds bought when people were really, really pessimistic and bond prices were high, bond yields were low, you're going to lose a lot of money. And you're going to lose that money whether you sell the bonds back to the market or you hold them through to maturity. Because what could have been done and should have been done instead in 2020 is that the government should have been locking in lots of long-term funding at those 1% bond yields. Instead, we were buying bonds back from the market and replacing them, paying for them with deposits at the Reserve Bank that are repriced every 6 weeks once the OCR is reviewed.
So it's like they weren't hedging, basically.
They were I call it a big bond punt. They were speculating on the market. They didn't see it that way. They thought they were doing something useful from a macro stabilization point of view. But from a financial analysis point of view, it was just a gigantic unhedged punt on the bond market, which would have paid off if deflation had proved to be a thing and we'd had 4 years of really, really, really low interest rates, but proved to be disastrous once it was shown that their forecasts and the market's forecasts were just wrong.
Okay. And we all got it wrong back then.
Yeah, absolutely.
I'd like to pretend like I didn't get it wrong. I knew what was going to happen, of course. But,
when you write a blog every day, you've got a paper trail, and mine's very long.
you can't change the story after the fact, right?
Yeah.
But when was it clear, though, that they should have course corrected, but they didn't?
I think it depends on what you mean by course corrected. I mean, in terms of the LSAP, you can make an argument that in March 2020, there was a limited role for intervention to help stabilize the bond market itself. So what had happened in the US was a mad rush for cash. The way you get cash most easily is you sell your most liquid assets, those treasury bonds. Treasury yields rose sharply. Those here rose as well. Now, you can mount an argument that once the Fed intervened, the world markets were going to settle down. But I'm not going to argue too strongly against the Reserve Bank doing that initial intervention. But once they'd done it, they should have said to themselves, well, hey, what's the point of intervening buying 10-year bond rates when nobody borrows linked to a 10-year rate? Let's focus our energies, if we still think the risks to deflation are real, on being able to cut the OCR a bit more. Because the OCR, if you get it wrong, you can reverse it really quickly, and there are no big financial losses for the taxpayer. But, I mean, moving on, the bigger question is probably more, when did it become apparent that the inflation outlook had changed dramatically? I mean, that was a gradual thing. It certainly wasn't clear at the end of 2020. You can look at all the market forecasts at the time, the market economists and their comments, and you find that there were worries about what was happening to house prices, but not about general inflation. So it wasn't really probably until the second quarter of 2021 when it started to become apparent that inflation was getting away on the bank. And that's probably where you can be more critical of their OCR stance, that even then it took them, I think, the best part of 9 months to get the OCR even back to where it had been just prior to COVID. They were very reluctant to accept that inflation was more than transient and that there were embedded problems, even though the data was starting to show that, for example, the unemployment rate was dropping away very sharply. All the indicators from the labour market were screaming massive labour shortages. That's the sort of environment that says your domestic economy's overheated. If the domestic economy's overheated, what you need to be doing is setting policy interest rates quite a lot higher quite quickly.
So let's just accept that maybe they didn't act fast enough to change some key settings. What would be some of the reasons why do you think that? Like, was it an organizational issue within the Reserve Bank? Was it political interference? Was it ideology? Was it outdated economics? What in your opinion, was the reason why they didn't respond?
The one that I don't think it was at all was political interference. You read a lot of stories that, the governor's in Grant Robertson's pocket. I just don't think that's true at all. I think what they made was a combination of an honest forecasting mistake. They just had the wrong models. They weren't looking at the right data. Their mindset had been shaped by the experience of the previous 10 years when inflation had persistently undershot. And then by what had happened in 2020, when everyone was worried that the unemployment rate might go to 10% and stay there because demand would be really weak. Then there were some unfortunate things like that second lockdown in 2021. They were just about to start to raise the OCR in August 2021, literally the day after the lockdown came in, and they put that on hold. Now, reasonable people can say, well, yeah, okay, I'd probably have done the same thing as well. But there was never any rush to catch up. Yeah, I think the biggest single influence is probably that previous 10 years experience combined with the fact that although some other countries had started raising before we did, the countries that we tend to look at most often, Australia, Canada, the UK, the US, haven't. And if anything, we're even slower than our central bank in getting off the mark. So there wasn't a lot of market pressure or peer pressure for them to have acted quickly. They may have been no worse than anyone else. On the other hand, they're the ones who took the job, right? The status, the prestige, the pay from being the Monetary Policy Committee, from having all that power to be the central bank, they're the ones that you should expect to get it right. And so one of my pushes has been, we need to think about what sort of accountability do we have for the people who made those decisions and got them wrong. Because the scale of the error is really massive. When we set that inflation target first 30 years ago, I don't think any of us really believed that we'd ever again see an environment where core inflation was up at 6 or 7%. You're sort of worried that it might get to 3 or 3.5. You could misread things and get things back under control. But we've had probably a 10% unexpected lift in the price level in the last 2 or 3 years. And that's a 10% tax on people who are holding financial assets. It's a massive redistribution. And it's a result ultimately of erroneous choices made by central banks.
You mentioned that term inflation targeting. New Zealand, I think, correct me if I'm wrong, Dr. Grimes perhaps was the inventor of the inflation targeting idea, which the rest of the world kind of adopted shortly after that, the 0 to 2% target. Most people focused on the 2%, it seemed, across the world. But do you believe that inflation targeting was actually quite an ingenious, revolutionary type of thing to unleash out there in the central banking world? And do you think that maybe we need something fresh like that going forth into this new world that we're heading into?
I'm a little bit biased. I was present at the creation. So when we devised it, I was the manager responsible for monetary policy strategy at the Reserve Bank, and Arthur and I and Grant Spencer, who was the chief economist at the time, and Don Brash a little bit later, were sort of the key people in terms of launching it. I don't think we really saw it as a revolutionary thing at the time. We were more in a pragmatic situation where inflation in New Zealand had been really high for a long period of time. We wanted to get it down. We were determined to get it down, and we wanted people to believe that we would get it down. We'd grown up in an era where people overseas had tried targeting the money supply. It hadn't worked. They tried fixed exchange rates. It hadn't worked. And so we were casting around, well, what can we do? And so an inflation target was more like a sort of reluctant fallback. There were long lags, so people couldn't count on us delivering very quickly. And I think all of us probably were surprised by the extent to which the idea took off globally. Do I think there's a need for anything particularly different now? No, I don't. I think that model has served us pretty well. It's evolved at the margins. But, fundamentally, the mistake of the last 3 or 4 years wasn't the inflation targeting regime. It was a forecast mistake. And it was a forecast mistake made by central banks and made by people in the markets, just misunderstanding pandemic economics. Now, should we all be critical of ourselves? Well, yes, we should. But equally, we hadn't seen a shock like this probably ever before. The comparison with the 1918-19 flu pandemic is valid in some senses, but not economically, because we just didn't lock down economies for months at a time or close borders for months at a time in 1919 in a way that we did this time. So if you get really unusual shocks, you're going to struggle to get the right narrative, get the right forecasts coming through them. So I'm comfortable with the inflation forecasting model. I think we need to reestablish it, get it in place quickly, and get on with delivering inflation consistently in something like that, 1 to 3% range. Personally, I'd be more comfortable if we lowered that target to 0 to 2, but that's a second order issue, really.
Yeah. Okay. So I guess one part of this is that you're trying to drive this economy into the future, and you can see the lanes. Let's say it's 0 to 3% inflation range, but you have a steering wheel that can really only turn in one direction. You know what I mean? We have a positive OCR. So this is going back to what you said at the start, where we went down to 0.25% OCR during the pandemic, and now we're up at 5.5. How difficult would it be to implement? And I know this seems like a really weird season to be asking this question, but how difficult would it be to implement a negative OCR? And would that kind of break things, or is that something that you think we might see in the future?
No, I mean, the Reserve Bank was shaken out of its complacency in 2020, and they now assure us that they are in a position to use a negative OCR if they need to, if there's another severe downturn. There are still limitations on how deeply negative they could take it. Probably they could only take it to maybe minus 0.75 or perhaps at a stretch -1. That's about as far as the Swiss and the ECB and a couple of other central banks have taken it. So for practical purposes, that now is a tool that's open to them. I don't believe the evidence internationally is that it will be particularly damaging. Of course, the circumstances in which you would want to take the OCR negative would be pretty bad circumstances in their own right. It's a pretty severe downturn or recession that you're needing to respond to. But what lower retail rates that would follow from a slightly negative OCR would do is provide that demand stimulus that you need in severe economic downturns.
Okay. So we've already talked about that inflation targeting, how the OCR is used to do that by influencing the cost of money. And the idea is to target price stability, because if we have price stability in the economy, then we have stable and hopefully predictable economic growth in the future. What would be your view around what some of the biggest challenges are today for the Reserve Bank of New Zealand? Because when I look at it, it looks like the world has changed significantly since March 2020, but it doesn't feel like the economic model that the Reserve Bank follows is adapting to that. Correct me if I'm wrong.
Yes, I'd look at it the other way around and say there's an awful lot of things that have changed, you're right, but there are things that are in the backdrop that a Reserve Bank can't influence. It just has to take account of. So you could think of, pushes to de-globalize, the tensions between the US and China, for example, that may mean that we have higher tradable goods prices in the medium term. That's just something that the Reserve Bank will need to factor in to its forecasts, as it did on the other side when the great age of globalization over the last 20 or 30 years was holding down tradable goods prices. Now, whether they adequately react to those things and judge their empirical significance is an open question for them as for other people. I mean, I think their bigger issues aren't so much the basic model they're operating with, but the way in which the institution itself has been somewhat degraded. So if you look around the Monetary Policy Committee, for example, that makes the decisions, we've got people with no monetary expertise at all. The Deputy Chief Executive of the bank, responsible for macroeconomic policy, has a marketing and accounting degree and no economics background. You wouldn't see it anywhere else in the world. We've had a ban on having people with ongoing research expertise on the Monetary Policy Committee. It's totally crazy. They seem to have lifted the ban now, and there's some new appointments to be made next year. And so we should be looking pretty carefully at the sort of people that they appoint. We've got a governor who has not given a single serious speech on monetary policy in 5 years. We've got a central bank that used to be known for the quality of its research, quality and volume, and now they publish hardly any. And we just don't get the insights from the bank. As well, there's a reluctance to acknowledge mistakes. Now, central bankers make mistakes. Why? Because they're human. All of us, all human beings, all human institutions will mess up and misread things at times. And the way in which we learn from our mistakes and improve is to acknowledge them, express some genuine regret and move on. And we don't get that at all from the Monetary Policy Committee, and particularly not from the governor.
Wow. Okay. There's a lot to unpack in that one, and and again, I'm just going to bring it right back down to the household, right?
Yeah,
So
sure.
we earn money, we pay tax on it, and then we kind of get taxed again in a way, because in one way, the government through the tax system will take an amount of our currency away. That's a quantitative piece. And then with the amount that's left to spend, it's more of a qualitative impact or a qualitative tax, in that the Reserve Bank effectively determines what value those things can actually hold, these dollars can hold. So if you kind of just think about it from that accountability piece, what would you propose would need to happen in terms of accountability going forward?
Well, can I just correct one thing? I mean, I think so long as you've got a positive inflation rate that's about what the target is, people can factor that into their planning. So it's not equivalent to a tax. If you believe that inflation will be 2% every year, and it is 2% a year, you can build that into the interest rates that you're getting from your bank,
Sure.
into your wage negotiations and so on. It's unexpected inflation that's the really nasty tax.
Sure.
But I mean, in terms of accountability, I mean, there are questions about serious questions about the way in which people who've been responsible have been reappointed in the last 18 months. As I look around the world, we've had a really bad experience in a whole bunch of countries, and hardly any central banker has paid a price. Now, the model that we set up 30, 40 years ago was to say, we'll make the central banks operationally independent. They can control the interest rates, but they have to do it to a target that we, the politicians, will set. They have a great deal of power, but if you delegate a great deal of power, there needs to be responsibility and accountability. And so I argued last year that it was simply wrong to be reappointing the governor, and to be reappointing the external MPC members who were appointed. And I had a long list of reasons. I came up with a blog post with 20 reasons for not reappointing the governor. Foremost among those was not the inflation failure, partly because everybody else had made a similar mistake. But there is still something in the idea of a scapegoat, if you like, that the person who took on the responsibility for delivering policy to deliver a slow and stable inflation and failed should not still be in the job today. You know, they've lost $12 billion through the LSAT program. It's one of the most obvious things. That's $2,400 per man, woman, and child in this country gone as a result of the MPC choices. Someone should pay a price for that. But then there's the lack of speeches, the appointments of people who just aren't up to the job, the lack of ongoing research, the lack of serious accountability. Adrian has been caught misleading Parliament on a number of occasions in ways that aren't arguable. They're just clear cut. It's the sort of thing that we should not accept from high public officials if we're serious about delegating power to these people. They need to be held to a high standard. If you look in the private sector, a chief executive of a company that was listed on the stock exchange who'd gone as badly wrong, his company had gone as badly wrong as the Reserve Bank has in the last 5 years, would not still be in their job. The share price would have been tanking. The shareholders would have been demanding that the board take action and change things. In the Reserve Bank's case, all the people who made those decisions through the last 3 years are still in office.
And I know we could talk forever around these topics, and it is really important because I think, generally speaking, over the last few years, there's probably been a steep decline in the level of trust with a lot of institutions, and media would actually be one of them as well. So, like, I look at the media, and then I look at central banks, and I go in New Zealand. Well, there's a couple of really cool reporters that do, I think, a reasonably good job. But in your opinion, do you feel like, and maybe this is a problem because the everyday New Zealander doesn't understand how this works, but do you feel like media does a poor job of getting the message across as to what's happening within the Reserve Bank?
Yes, but I think it's almost inevitable in a place the size of New Zealand. We're talking about sort of mass media outlets. I think, you're touching on a couple of good journalists, Jenny Ruth, who writes independently these days, and Junaid Tibshrani at the Herald, have both done some good work in this space.
Yeah.
But, they are writing for widespread audiences, and a lot of these points are relatively technical. I think the onus probably needs to be more on the politicians and the senior bureaucrats who have responsibility in these areas to be taking those responsibilities a lot more seriously. You can't really expect there's going to be a mass public groundswell worried about the technical details of how much money the Reserve Bank's lost, just because it's hard to get your head around how those losses even arose.
Okay, well, let's move on now and zoom way out of New Zealand. Let's have just a quick look at what's happening in the rest of the world, because again, like I kind of feel like we are in a new world, and to a certain extent, we need to be thinking differently as investors. You may disagree on this in terms of the economic models that the Reserve Bank uses, because, well, what else do we know, right? But I know that usually with most of our models, we're looking backwards. And so when we're looking at the world, we're often referencing history as well, which tinges our thinking. So just as a general overview commentary, what's your general thoughts around what's happening right now with the Middle East situation?
I mean, it's just terrible, the events on the 7th of October, wasn't it? I mean, my parallel I've just put on Twitter this morning is a parallel with World War II. When the Germans invaded Poland, lots of people died as a result of the war that we and other countries declared to topple the Nazi regime. War is awful. Terror is awful. But sometimes it's unavoidable. I mean, there's a just war tradition in Western thought that, seems very powerful and relevant here. I mean, I think Israel is going to make mistakes. Israel is a human country. It has a government of people who are human. They may make big strategic mistakes over time, but fundamentally, right is on their side in this particular episode, and you just cannot have the evil that we saw in those attacks on the 7th of October being operated out of a place just across the border from your towns and cities.
Yeah. And so I guess some of the rippling out effects of this conflict is now, seems like every time you look at the media or the news, there's stories of more and more escalation. It obviously has an impact from an investor's point of view, I guess, and it seems a little bit odd looking at like the sheer horror of what happened on the 7th to then talk about how does it affect my portfolio. But this is an investment podcast, so like I'll try and stick to the knitting here. But the impact here is obviously inflation, right? And if we consider that oil effectively is in almost everything that we use and consume, then if the price of oil goes up, which is typically what happens when these types of countries get more involved and when things escalate, that could be quite problematic. So from an inflation point of view, can you just describe to us here in New Zealand how that war, if that does push the price of oil up, how that could affect us here in New Zealand?
Yeah, I mean, I think the big challenge always for central banks is that, oil prices rising are fundamentally a negative shock for countries like ours. We import oil, we consume oil. If the price of oil rises sharply, we are poorer as a result, and that's inescapable. Headline inflation goes up, as you say, when petrol prices rise. And so what the Reserve Bank needs to be doing in that sort of environment, and this is what central banks didn't adequately do in the oil shocks of the 1970s, is to say, we're going to be preemptive and we're going to respond in a way that makes sure that we don't cement in permanently higher rates of inflation. We have to accept that we're poorer and that simply having temporarily higher inflation is not a way through that. I mean, you're right more generally that there's a huge range of uncertainties at the moment about the global economic environment. And I mean, that's not just the potential oil shock out of the Middle East war, but it's also, where are neutral interest rates going to settle as we come through this inflationary shock? Quite how is that tensions with China and the deglobalization things going to play out? So, yeah, I mean, in terms of your investors, these are really important considerations. For the Reserve Bank, it's always really just business as usual. It's looking at the medium-term outlook, looking at the short-run shocks to prices, and making sure that when you get those one-off shocks, which you will get from time to time, that it doesn't become entrenched. That's a bit harder to do at the moment because people have seen such high inflation in the last 2 or 3 years. So whereas if the shock had been happening 4 or 5 years ago, when inflation was 1.5% to 2%, people would quite happily live with inflation maybe going to 3% briefly because the price of oil went up. In this environment, if we saw a nasty oil price shock and saw inflation go back to 7 or 7.5%, the risk is that that would entrench people's expectations that inflation was going to stay higher for longer, influence their wage claims, their borrowing behaviour, and so on. So it might be that the Reserve Bank would have to react more aggressively now than it would have if it had kept inflation low throughout and then was faced with a shock like this.
Let's just say that oil does go significantly through the roof and that increases inflationary pressures. And we already have a high inflation. I think it's 5.6%. So,
Yes.
Hey, great news. Your $100,000 is now worth 50 grand in 13 years time. So that might sound better than what it was, but it's still pretty horrible.
Yeah.
But putting that aside, if we have the situation where we do need to lower rates, but on different parts of the economy, that's kind of what I'm stuck on. So let's just say, for example,
we can't, right? It's a single tool.
Yeah, exactly. So like, do you, and I'll explain it maybe as like a heterogeneous interest rate, right? Where it's not the same for different sectors. The government gets the cheap money. We get the expensive money to mop up the mess. That's kind of what I think of it as. Do you see a world like that? And do you see the Reserve Bank using the current tools effectively in that world?
It's the only tool they've got. I think the tools are perfectly functional. And people angst, for example, at the moment, you've seen quite a lot of it in the media in the last 6 months about the burden on young homeowners, for example. And no doubt it is tough on them. But, at times when we've been disinflating in the past, a lot of those pressures have been seen, for example, in the exchange rate. And so in the 90s and 00s, we used to hear endless complaints about the burden that disinflation was putting on exporters. And you could be sympathetic, but there was no credible alternative. The price of money is the price of money. You can come up with clever clogs interventions that try and say, let's have one rate for this sector and this rate for that sector. But those sorts of schemes set up massive evasion and avoidance opportunities. And secondly, they're just inefficient in their own right. I think one could have more confidence in the Reserve Bank if it was staffed with more expert and able people who'd shown themselves to be accountable, to be thinking hard. But the tools they have will do the job, but it might be quite messy. And, you think back to the first oil shock in the 1970s or the second one in 1979. In both cases, they were followed by recessions, both here and abroad. The world economy is probably already teetering on the brink of recession, just from the efforts to bring inflation down already before this Middle Eastern shock and the potential shock to oil prices hit. So the economic outlook for the next couple of years doesn't seem particularly pretty at all. For the Reserve Bank, all it can do in that environment is to say, we're going to lean against, we're going to make sure that we deliver inflation back near the target range. The other problem then is that, we've had so much money spent by the government in the last few years and are running such big fiscal deficits that we don't even have the fiscal leeway that we might have thought that we had 4 or 5 years ago. We're starting from one of the largest cyclically adjusted fiscal deficits anywhere in the OECD at the moment. Chris Luxon's just been on the radio this morning, or TV this morning, reasserting their commitment to delivering surpluses again by 2027. That's going to be a tall order. It will only be made harder if the economy slows more sharply than the forecasts currently allow.
So then thinking that, hey, events are probably on the side of the Reserve Bank in terms of its efforts to get inflation down, because the likelihood of recession, certainly from where I sit, seems to be picking up, and then global events are definitely helping that as well. So we're starting to see the rate of inflation dip just a little bit. It might be a bit premature to get excited about that, but seeing as things are starting to maybe shift, what do you think about, like, say, the next 6 to 12 months? What do you see happening with the OCR as that primary tool?
My view has been that they should have had the OCR higher than it is in the last 6 months to give themselves greater degree of assurance that inflation really is coming down. You made the point that we can't get too excited about what we've seen so far. And that's exactly right. It's a long way from 5.6% to 2% inflation. Having said that, it's pretty clear that the Reserve Bank will not move in November. And by the time we get to the next review after their long summer holiday in February, it really is anyone's guess. There are some quite strong conflicting pressures at the moment. On the one hand, monetary policy has tightened a lot, and that is acting as a drag on demand. We're seeing consumer spending weakening. On the other hand, we've got a really big boost to demand in New Zealand and similar shocks in Australia and Canada from really high levels of inward migration. Now, you can debate the longer term merits of immigration all you like, but in the short run, a big influx of people means a demand for houses, schools, shops, roads, all the infrastructure that we take for granted and that new people living in our society need. So that is quite a boost to demand, and it is acting in the opposite direction to monetary policy. So I'm still with a couple of the domestic banks who think there's a reasonable chance that the Reserve Bank may need to raise rates again, either now or early next year, but with big margins of error around any sort of view. It's always worth remembering, macroeconomic forecasting is something of a mug's game. Nobody can really get it right beyond really short-term horizons.
Yeah, no, well said. And I think having a bigger margin of error makes sense this time around because, like what happens if we have the same problem as what we did after the pandemic, but in reverse, and they overshoot, and then we're well into the deflationary terror zone that central bankers seem to have. I guess we would find out if those negative interest rates work then, right?
Indeed.
Yeah, man, good times. All right, well, if anybody wants to find out a little bit more about you, where's the best place that we can point them to, Michael?
Okay, so my blog is www.croakingcassandra.com, and I write there probably 2 or 3 times a week on a range of macroeconomic topics.
Yeah, and it's all good stuff. You can understand it, people. You can understand it, so I do. Check it out. It's great. Awesome. Thank you again very much. Appreciate your time, Michael. Hope you enjoy a good summer coming up.
You too. Thanks, Darcy. Good conversation.
All right, cheers. Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.